The high interest rate environment continues to hit the REITs market. That is why the S-REIT index has dropped from a high of 1089 in October of 2024 to currently 914. Even though interest rate has started coming down, this does not mean that the REITs dividends will start to stabilize or recover. It depends on individual REITs on how they manage their debts and whether their property is attractive to get higher tenant leases. Without both of this, the REITs will not be able to grow organically. So in this video, let us go through the 3 Mapletree's recent results, and that is Mapletree Logistics, Mapletree Industrial, and Mapletree Pan-Asia Commercial Trust. So let's go to the first REIT, and that is Mapletree Logistics Trust. MLT is a REIT which owns purely logistic properties, and logistics is always an in-demand property class. However, in recent times, they are facing a performance issue with their China properties, which is a bulk of 18.5% of their assets. It's a significant amount as it contributes 17.4% of MLT's overall revenue. For REITs, the important factor that determines the REIT's organic revenue growth is rental reversions. Rental reversions is a metric which shows the new leases signed having a higher or lower rental rates than before. Singapore leases continues to come in strong at 7.5%, while Japan at 5.4%. However, China is the problem as it continues with a negative 10.2% rental reversion. This will continue to be a main problem that will pull down MLT's dividend. Now that we have seen rental reversion rates, the number of leases expiring is also important. For countries that have good rental reversion rates, it's good to have leases expiring as they can be renewed at higher rates. However, it's the opposite for rental reversions that are in the negative range. For this financial year of 2425, they have China leases as the highest number of leases that needs to be renewed. This is not good considering the negative rental reversions that will be expected. Even though we know that China's economy might not be doing that well, another factor that might be contributing to the lower demand in the logistics spaces is due to AI optimization. With AI optimization, lesser logistics spaces would be required. With lower demands, this means that customers have the power to demand lower rental rates. On the bright sides, the leases were being renewed without the compromising of having a drop in occupancy. But because of the high amount of China leases that needs to be renewed, I'm afraid that this financial year and financial year of 2025 will continue to see revenue drop. With the overseas properties, especially China leases not doing well, this has led to bad results for MLT. Revenue and NPI continues to drop both quarter over quarter and year over year. Property expenses also increased slightly while borrowing costs maintained the same. But for the borrowing costs, if we compare year over year, it's increased by 8%. So with the income dropping while expenses in properties and debts increasing, the drop in dividends to shareholders is expected. For their debts, leverage ratio went up to 40.3% while cost of debt across their debts is at 2.7%. Their adjusted interest coverage ratio also dropped from 3 times to 2.9 times. Now, these values have actually some warnings that can be seen here. Currently, their cost of debts to me is still at a very low level as compared to the current interest rate environment. This means that the potential refinancing of their debts will most probably bring up their borrowing costs and thus more debts expenses for MLT. We can see that for the next few years, they have lots of debts that needs to be refinanced. Based on the current interest rate environment, I will focus on the next 2 years' debts. With 32% of the debts that needs to be refinanced, I do not think that the debts that they refinance will be lower than the average cost of debt of 2.7%. This is just my speculation because REITs do not usually show the individual cost of debts of different years. But to me, as an investor, that is something that you have to take precaution of. So what can we conclude from MLT's recent results? With the China negative rental leases and potentially refinancing of their debts, I feel that MLT will continue to experience drop in DPU due to the drop in revenue and increase in the borrowing costs. One of the things that might help MLT is the new redevelopment of the Logistics Singapore property by first half of 2025, which might help to bring in additional income. For this property, we have to see once it's fully refurbished and running. At the current share price, they are priced at a dividend yield of 6%. MLT has a good track record and good management, but at this current moment, if the refinancing of their debts is going to be more expensive, I would expect their dividends to continue dropping. Now let's go on to the next REIT, and that is Mapletree Pan Asia Commercial Trust. MPACT is a retail and commercial property with their overseas properties continue to perform badly. However, if we focus on their Japan properties, it's also performing badly with income dropping from 47 million to 34 million. The only properties that are doing decent is their MBC and VivoCity. The rest of the properties are experiencing drop in income year over year. For retail properties, tenant sales and shopper traffic are important bread and butter metrics for them. Both VivoCity and Festive Walk continues to experience drop in their tenant sales, even though shopper traffic has stabilized. This is why their tenant retention rate is at a low of 46.1%. The bright side is that their overall rental reversions across the portfolio is positive at 4.6%, but we will have to see the breakdown of their individual country properties to know the true performances. The overseas properties leases continues to perform badly with negative rental reversions. This is the main reason why their income for overseas properties continues to drop. Unfortunately, Festive Walk rental reversions also dropped even more at negative 7.2% from the previous quarter of negative 6.1%. MBC, VivoCity and the Singapore properties are the only ones that is performing well, which is the main reason why their overall portfolio numbers looks okay at 4.6%. The overall occupancy for MPACT's portfolio did not have much changes, but one particular to look at is the China properties. Not only are they experiencing negative rental reversions, they are also experiencing drop in occupancy. This meant that even with the lower leases offered to the tenants, they are unwilling to renew and therefore vacating the area. VivoCity continues to be their strongest assets with almost 100% occupancy. For their Q3 comparison, the revenue and net property income continues to drop. Therefore, even with the positive rental reversions, there are few other factors to actually look at. For MPACT, their reasons was due to the divestment of Mapletree Anson and the currency strengthening of Singapore dollar. In my previous analysis, I have mentioned that with the sales of good assets like Mapletree Ansons to pay down debts, it's important that the decrease in the property and debt expenses outweighs the drop in the income due to the loss of the asset. Even though year over year the DPU dropped by 9.1%, if we compare quarter over quarter, they managed to stabilize their dividend. With their property expenses stabilizing and finance costs dropping, they are moving in the right direction. Looking at their debts, it seems to have stabilized with leverage ratio at 38.2%. Interest coverage ratio was at 2.8 times with the average cost of debt of 3.52%. However, for next financial year, they have a chunk of 919 million of debts that needs to be refinanced. We do not know how much or what is the cost of debt for these debts, but if it's cheaper than the current rate, we would expect their borrowing costs to increase this year. So for MPACT, the sales of the Mapletree Anson might be a good move as their dividends managed to stabilize this quarter. Their overall net property income continues to drop with overseas properties continue to perform badly. If they do not overturn this, their income will continue to drop and might lead to a lower dividend in the coming quarters. At the current share price, the dividend yield will be around 6.69%. However, with the drop in the property income and the possibility of increasing borrowing costs, there's a risk that MPACT's dividend for this financial year might continue to drop. Now let's go on to the last REIT, and that is Mapletree Industrial Trust. MIT has been one of the better ones of the three Mapletree REITs. The main reason is because their properties are only in the US and Singapore, unlike MLT and MPACT, which have properties in China and other countries. What makes MIT so valuable is the growing assets in their data centers. The dividends this quarter increased by both year-over-year and quarter-over-quarter, which is very good news. Higher property and distributable income was thanks to the new Osaka data center acquisition and new leases that has renewed at a better rate. The most valuable assets is their data center. With AI development, the demand for cloud spaces will only increase, and therefore I expect the demands for data centers to continue to increase. This will definitely benefit MIT during this AI revolution. Other assets such as high-tech buildings are decent but are not as attractive. This quarter results looks better with distributable income at 97.5 million and increase back up to 3.41 cents for their dividends. Historically, MIT has been constantly increasing their dividends, but because of the recent high interest rate, their dividend growth has been stagnant for the last 5 years. Looking at this quarter's results, revenue and income both dropped by 2.3% and 0.9% respectively. However, this quarter, their property expenses and borrowing costs also decreased but at a much larger value. This led to a higher distributable income of 1.3% and therefore higher dividend to shareholders. Surprisingly, borrowing costs decreased due to lower floating interest rate. But what is the problem? With 78.3% of their debts fixed or hedged, there is a risk that those debts that needs to be refinanced will possibly renew at a higher rate. If we see their debt maturity profile, they have 24% that will need to be refinanced in the next year, which is a risk in my opinion. Moreover, in the earnings call, they have mentioned that the full year impact of the higher interest rate costs will be impacted in the next financial year due to the lagging effect. So this meant that we might expect to see their borrowing costs to continue increasing this year. On the bright side, the loans that needs to be renewed in the financial year of 25-26 might be looking at 100 basis to 150 basis point higher rather than financial year of 2024 where it was 300 to 350 basis points higher. This means that once these debts are renewed, the increase in borrowing costs will not be as significant. MIT's occupancy does not look the best, with high-tech buildings showing the largest drop in occupancy this quarter. But in the future, data centers will be the major one that will affect MIT's overall income. Currently, their North American data centers is facing an energy limitation problem. So unless they resolve the energy issue, I feel that the North America income will maintain stable or slightly decrease for a while. Another risk to look at is the leases in AT&T. In the earnings call, MIT finalized a 17-month extension with AT&T at a 20% lower rental rate than the first lease extension. This was accepted to avoid downtime and zero income situation, as AT&T was noted to be leaving the data center soon. With this comment, I'm not sure whether is it because the competition in America is very difficult such that Mapletree Industrial Trust data centers is not getting the tenants that they want or other reasons. So this is one risk to take note of. In the long term, I continue to believe that data centers will be the crown for the future growth of MIT. However, in the short term, I expect their borrowing costs to continue increasing from the refinancing of the financial year 25 and 26 loans, unless there's a surprisingly large cut in the interest rate globally. So what can we conclude from MIT's earnings? MIT continues to perform decently with stable dividends. Their data centers should continue to do well and will propel MIT's dividend in the future. However, in the short term, large amount of debts refinancing and the US data centers tenant and energy issues will be a problem for MIT. At the current share price, the dividend yield is around 6.2%. Overall, MIT was the best performer out of the three REITs. Even though they have good management, the importance of debt refinancing will definitely affect their borrowing costs during this high interest rate period. Thank you so much for watching. I hope this video brings about good information with regards to recent Mapletree REITs results. Do look forward to the other analysis that I'll be creating soon. You can also watch my previous videos where I talk about the possibility of REITs earnings and why banks are still the best dividend stocks in Singapore. Thank you, and I'll see you in the next video.